So this is Steve Wolff with another one of our Steve Stock Stories. And I'm here today with Greg Carroll, and Greg and I have been on this for a couple times. He's becoming my co-host, I believe. But we're here to talk about a topic that you usually don't hear much about called structured notes. So Greg, give us a little input as to what a structured note really is.
In its simplest terms, Steve, the structured notes are bonds that don't pay a particular interest rate like you're normally used to. The return on these notes is going to be based on certain indexes like the S&P 500 or the Russell 2000 or a commodity index. But the structure part is you're protecting some of your downside when you structure these notes. Your return is going to be based on the price movement over the term of that note. And so you need to hold these till maturity. It's not something you would sell in intermediate term.
Okay, but so what makes them structured is that someone, and in this case it's a bank, right?
Correct.
Some of the bigger banks, Barclays, who else?
UBS, JP Morgan, Bank of America.
Okay, they structure these notes to give you some downside protection and sometimes some upside participation.
Yes.
More than just normal, correct?
Correct.
So can you give like a hypothetical of what might occur?
Hypothetically, if you were worried about the S&P 500, you might look to one of these banks and see how they're pricing a structured note over the next 3 to 5 years. If you don't want any more downside than say 20% below where you're at today, based on maturity, if the stock market were negative, you want to cap your loss at 20%. What does that give you on the upside? Well, it depends on the current interest rate environment and other forces, but you're going to get somewhere around all the upside, maybe a little less than the upside, or more than the 100% of the upside.
Okay, so they structure these things to protect somewhat on the downside and maybe get a little bit more on the upside. And they do this through something as I think it's called a buffer or a barrier, right?
Those are two of the more popular ones, yes.
So when they put it together, they put this structure together so that, let's say you have a buffer. Explain what that is.
A buffer is where you're protected to a certain level. Hypothetically, let's say it's 10% downside. If the indice at the end of the term is down 0 to 10%, you get your money back. You're even.
That's if the buffer is what?
If the buffer's at minus 10%.
Okay.
Okay.
So whatever that percentage is, minus 10, minus 20, minus 30.
Correct.
That buffer will protect you on that first 10, 20, or 30%, whatever
Yes.
the structured note is. Then what happens after that?
After that, you are now starting to lose. Usually it's 1 for 1. So if the market's down, say, on a 10% buffer, the market's down 12%, you're going to lose 2%.
Okay.
So you're just, that first, whatever the buffer is, that's your kind of
That's your downside protection.
downside protection. You start losing after
That's why
that.
I call it the condom of investing.
Yes.
It protects you.
It does protect you, yes.
So that's a buffer. All right, let's talk about a barrier. What's the difference?
The barrier now is where you're protected again down to that barrier amount. In this case, let's say assume 10% again. But if the market closes at maturity below that barrier, you are subject to the full downside. So in this case, if the market were down 12%
On a 10% barrier.
on a 10% barrier, you're going to be down the full 12%.
Okay. Now, there's also participation on the upside.
Correct.
And on some of these structured notes, you can get more than what the index did over that time frame, whether it's 5, 3, 2, 1, whatever it is.
Right.
So explain that.
So, the pricing of these notes, the more protection you get, the less upside participation you're going to get. So in the barrier, where you're fully subject to all the downside below that barrier, that's going to give you more upside potential. The buffer, which gives you a full protection down to the buffer amount, and then you just start participating in losses below that, it's going to cap your upside a little bit more than the barriers will.
So it seems like this might be good especially for someone who's a little bit nervous about the markets.
Yes.
We've just gone through the last couple of months, pretty rough markets. And I know that, people always get really worried when, your money is dwindling. So this seems to be an interesting security to actually have in your portfolio, where you have maybe some protection on the downside and maybe even more on the upside than the markets already do.
Correct. Yes. And, in these markets where people are getting so nervous, and sometimes, we get these calls, it's like, you got to get me out. Let's get back in when the market bottoms. And we know that that's impossible. So this is an alternative to just totally getting out of the market when we know over the long term it should do just fine.
Hopefully.
Past
performance, no guarantee of future results. We know that.
But this helps give the client some comfort that, all right, even if it dips in the near term, I'm looking out 5 years. I can see where the market's going to be okay by then. But even if it's not, I've got that certain level of protection and I'm comfortable with that, whether it's 10, 15, 20, 30%, all the way down to 50%. You can structure these pretty much any way that you need to make yourself comfortable.
Right. So, and just so people out there know, I mean, we're this is just talking. We're just for informational purposes. That's what this broadcast or this podcast is all about. And please just don't go out and buy something that you really don't know much about. Talk to your financial advisor before you do any of purchasing on structured notes, right?
Correct. There's a lot of moving parts underneath. So you just want to understand how those are. And then some of the terms can be confusing. So you need to talk to someone that's really, has a lot of experience with these to totally understand them, to make sure they're right for you.
So what are the risks involved in this?
I'd say the biggest risk would be, outside of the structure of the note, would be the issuing bank. The bank, the note is a bond issued by a bank, and if that bank were to go bankrupt, then you're in line with creditors based on that.
Right. So
the likelihood of these large banks going bankrupt is pretty small.
It's small, although we have seen it.
We have seen it.
I remember Lehman Brothers going out of business.
Correct.
And a couple of others. It could happen, so you want to make sure that whoever that bank is that's issuing the note is a high-quality bank. And most of these are. I mean, J.P. Morgan, Morgan Stanley, Barclays Bank,
UBS.
UBS. There's a whole bunch of them.
Yeah.
And,
we only work with the top of the food chain as far as the banks go.
As far as these structured notes are
Yes.
concerned. Yeah. So what about the fees in this? Are there internal fees?
There is a structured fee that when they put these together, it's built in, and the returns that you're quoted up front, the downside protection, the upside potential, all of that is net of that fee. So you know exactly what you're going to get at the end of the day. There are no fees in the front end or the back end that you're not aware of that aren't disclosed.
And as far as where people can get this, is this something that really only goes through advisors, or do you know?
I believe through advisors and brokers only. Brokers, that's a good point. Brokers do charge commissions on these. There's different pricing between a broker and a fee-based advisor like us.
Okay. So there's no extra charge if we do it. There's a commission if a broker
If a broker does it, I believe there's usually a commission.
Okay. So and that's something you'd probably have to find out. Make sure you know whether that's right or not. But,
Correct.
But ask them. So it's interesting, too, because I think when the market is down and people are really scared, it seems like maybe you get the best terms then. Because if the market's already down by 20%, it's like kind of what you said before. I mean, historically, the chances are it's not going down by another 30%, although it could happen, and it has happened.
Yes.
But even if it does, okay, if the market's already down, and then you get maybe, if you could structure one with 20% protection on the downside, your downside exposure is really limited.
Yeah, and I think
could be limited.
It could be. And what these notes do is they help you stay the course. So you get through
Right.
that business cycle and the market cycle so that, when it matures, hopefully the market's in a much better position where you are getting the returns that you might have thought you would have gotten.
So you had said earlier about if you can structure these notes. Now, is this something that you can do yourself? Is it something that's off the shelf? How does that work?
For certain clients, we can structure notes at a certain dollar value, usually $500,000 and above. But all these banks do put out certain structures on a monthly basis. They're always changing. The market environment's always changing, so the pricing is changing because the volatility in that index creates the pricing differences, and the interest rate environment And obviously the term, whether it's 1 year, 3 years, or 5 years.
Okay, so the banks put out these notes and go out to the advisors, and the advisors then say to your client, here's what's available now.
Correct.
If you have, and by the way, I think the minimum is what, about $1,000 in most cases?
$1,000 on those shelf products from the banks.
Okay,
Yes.
but if you have enough money, and like you said, 500,000 or more, or $1 million and more, depending on the bank, then you can actually ask the bank to structure something just for you.
Yes, you can.
It's pretty interesting.
Yeah.
So, there are things out there I think that most people don't know, and I think structured notes is one of them.
Yeah, and I think it's just a great alternative to your traditional stock and bond portfolios. It can give you a certain amount of protection or comfort that hey, I don't have to worry about that piece as much. I know I've got some protection in there, and maybe it helps you sleep at night more and get you through some rocky markets like we're currently in.
And that's the key, I think. Most people when they say I can't make money in the stock market, mostly it's because one of a couple of things. Usually it's that they bought something that's just a complete speculation and it's just gambling.
Yes.
Or they get scared out.
Yes.
And more people I think get scared out than anything else.
Absolutely.
So this might keep you from doing that, and in the long run probably it would be pretty good.
Yes.
So structured notes, interesting concept. And Greg, I really appreciate you being here.
Thank you.
And this is another one of Steve's Stock Stories, and we'll see you next time. Thanks a lot. Bye-bye.